In the last 18 months, I've built my ETF investments from zero to 40,000 euros. So in this video, I will share my investing journey and 5 lessons I've learned along the way so that you don't make the same costly mistakes I did. Hello finance people, my name is Robert and I'm here to share with you my learnings and experiences about personal finance as a European. So I started my investing journey actually back in 2017, but I started with stocks, crypto and things like that. And about 18 months ago, I decided I wanted to just go full on with ETFs. I'll have some little money for individual stocks and crypto, but mostly I want to invest in ETFs. So that's how my journey kind of progressed. So let me share with you what I've learned so far. First of all, just start as soon as possible. As soon as you have 200, 300, 400 euros, just invest that. If it's lower than 100, maybe would wait a little bit longer so that you don't, every time you buy something, you actually pay fees, so that those fees are not a big proportion, proportionally big compared to what you're investing. For example, $1 fee is nothing if you're buying with $1,000, but if you're buying with 100, it's already 1%. So I would wait and collect a little bit money, but invest as soon as possible because it will be a journey. For me, it started more risky. The longer I've been doing it, the less risk I've taken so far. And personally, the mistake I did is that I waited too long. I saved up a couple of thousand and then only started investing. Although I started with smaller amounts, I still had that money. And I thought, oh, I need enough money to invest. But actually, with the modern platforms, you can start with very low amounts. So it's better that you start young and you get used to this. And then, you progress as you learn more. And anyway, consistency beats amounts. So if you're consistent with your investing, that's more important than, having, 10,000 one go. I would just start developing that consistency. So if you take a look at my portfolio right now, you can see that most of it is in ETFs. I have 64% in ETFs. And then I have some crypto, peer-to-peer, and stocks. Now, to be honest, crypto is bigger than it should be just because this is now November and we had a big rally in Bitcoin. And I have the biggest portion of my crypto is in Bitcoin. So that's why it looks so big. Usually it's actually smaller than this. The second lesson I learned is that the less decisions I make, better it is. And I have a good example of this. So what I did when I started with ETFs, you can see here in the beginning of 2023, that's when I started buying them. But you can see that I'm not even buying them at the same day. So here there's a gap. In February I didn't buy. Then also, what is that? In April, May I didn't buy either. This is because I had to decide and manually buy this ETF. If I need to every month think about it and decide when to buy it, what happens is that I overthink it. And then the market rallies by 3%. In my mind, it's like, oh, I'm overpaying for this because it just rallied. So let me wait. And I wait until it's the next month. So it just doesn't work for me. It's better that it's out of my hands. I don't even see when it happens. This way, I've been more consistent. You'll notice here after this point, here, it's every time on 28th or 29th, and you see it's just consistent. This whole year is being consistent, and the only reason for that is because I set up recurring investments and I let it do it automatically. Otherwise, if I make the decisions, I always get too greedy. Because my strategy is to euro cost average, so I just invest about same amount of money every month. Even if I had a bigger amount of, right now, I would still take that, let's say it's 10,000, I would take that 10,000 and divide it into 12 parts so that every month I just invest the same amount. It just works better for me because I feel like if I would invest all 10,000 at the same time and the market dips, I just feel so bad. Whereas if I just distribute it this way, I might have made less money, but I also have the risk of losing money is lower. So that's why I like euro cost averaging. And speaking of ETFs, I've started a newsletter where I share my thoughts about investing and personal finance from a European perspective. For example, a few editions ago, I dove into whether you should invest in euros or dollars when buying a US stock. If you want to receive the weekly newsletter, just sign up. The link will be in the description. Now, the third lesson is about the dividend payments from ETFs like S&P 500, right? Just to give you background, there's 2 types of ETFs. You have the distributing and accumulating. Distributing basically pays you the dividends immediately when they're available, whereas the accumulating, it just takes that dividends and reinvests in the same asset. So you never kind of see that dividends coming out. They just grow inside whatever you bought, right? So I started with the distributing because I thought, hey, it would be cool to see the money coming to my account, I would feel like motivated and things like that. But it turns out I just didn't care. The amounts were so small, 15, 20 euros every quarter. It wasn't just significant enough for me to sort of go and like, whoa, I'm actually making money in my sleep, because it was so little. So that's why now from October, I started just buying accumulating, because I just didn't see the point. And the sort of disadvantage of distributing, in some countries you might have you have to pay tax on those dividends because you've received them. Whereas with accumulating, you never see them, so that means you don't also pay tax on them until you take everything out one day in the future. Now, when you're starting out with ETFs, there's a lot of different companies that offer ETFs. So, for example, you have the popular Vanguard and iShares. So deciding which one go for was kind of hard. There's so many opinions on Reddit, on online in general, so it was kind of hard to decide what you're doing. But in the end, in the beginning, just go with the big one. Vanguard or iShares, they're both perfectly fine because they also have very low fees. So don't overthink it, just go for it. Because for me, it took me probably a month just to decide which one go for, because I have a bit of analysis paralysis, because I overthink things, especially when it comes to money. The only thing with these companies, it's important that you have high enough volume in terms of trading. And for example, you can go to justetf.com and check out each of the ETFs, the information about them and how they're trading, who's behind them and things like that. So if you want to have even more details, you can do that. But I would just advise, go for the big ones because they're traded more often. You're going to get a good price for them. And if you're not sure what type of ETF to buy, you can come here to Just ETF and, for example, here are the indices. So if you want to just track what S&P 500 does as an ETF, then you click on S&P 500 and you can come here and just pick the largest ones. For example, if you look at these, all of these are great options. The only thing I would just say is that you would pick one that is in your currency. So we're in Europe, I would just buy it from European exchange. So make sure this iShare is also available in one of the European exchanges or in your broker. Or if they don't have, then just go with the next provider like Vanguard or something. This works the same for different indices as well. You don't need to be stuck with only US. You could also you could also consider the world ETFs, or you can just look at the Euro Stock 50, the 50 biggest companies in Europe. But the most popular ones are S&P 500 or the world. The fifth lesson I learned about ETF investing is that you should have a small part of your portfolio in the fun stocks. Especially if you're still young, you want to experiment things, you should have some things that make you excited. For me, right now, you saw it already, I had about 33% in the fun part. It's a little bit more than I would like to. I would like to keep it to 15%, but it's just because in the last year and a half, they grow a lot. So that's why that pie has grown more than the ETFs. But this is normal. If you're lucky, if you catch a nice wave, you can ride the waves of some of these stocks. So it's nice to have something that you look forward to, but it doesn't cripple your finances. If something bad happens, if they drop by 40%, you're still good because it was just a small part of your portfolio. And while I was editing this video, I realized that obviously you don't have to have this. If you're completely fine just investing in ETFs and just keep it consistent, that is a really good strategy. However, if there is some desire inside of you to actually be a bit more risky, a bit more speculative, then I would definitely just allocate a small portion of your portfolio to this kind of more risky stuff that you want to do. But personally, for example, I don't add more money to it now. It's grown out to big enough and I can now take either money out of it, put it in the ETFs, or keep it as is because I know that's mostly profit right now. So I can play around with that. Personally, I really like this because I don't like to speculate, but I guess to some extent I do like to take a bit riskier bets, just so that it's nicer to see when the stocks grow by 30, 50, 100% within a few months. And this is only possible with individual stocks or crypto because ETFs, they don't do this. They're more long-term, for long-term investing. Now, we live in uncertain times, so I got worried about what if my broker goes bankrupt? What would happen to my money? That's why I created this video right here, where I talk about the protections you have if the Giro, Interactive Brokers, or eToro go bankrupt.